The most dangerous man in banking. Jerome J. Powell. J. Powell, an American lawyer and investment banker, has been the Federal Reserve's 16th head since 2018. J. Powell was born and raised in an affluent suburb of Washington, D.C. He attended Princeton, then returned to his hometown to attend Georgetown University to study law. Soon after, he entered the financial sector on Wall Street by joining the companies, the Carlyle Group and Dillon Read and Company. The world's most powerful central bank is led by 68-year-old J. Powell. Why is J. Powell the most dangerous man in banking? J. Powell is rewriting some of the rules of the American economy as it goes along by improvising as it goes. Powell's background inside the Wall Street debt machine is at the heart of the Fed's most contentious policies. In his years as a dealmaker for private equity, Powell created and sold the types of debt instruments that he eventually bailed out as chairman of the Federal Reserve. The drastic moves Powell made to inject additional money into the markets, which are widely acknowledged with keeping the economy afloat throughout the pandemic, have also been quite advantageous to his former colleagues in the private equity industry. No evidence exists, to be clear, that Powell has acted in any way at the Fed in order to personally benefit himself or his former employers. But Powell's career sheds light on the more fundamental truths surrounding the Federal Reserve and the U.S. economy. The Fed's policies are not merely the domain of math-solving PhD economists. Programs being implemented by the Fed produce winners and losers. People like J. Powell and the investment companies that helped him get wealthy are the winners time and time again. The financial stability of the banking system has been weakened by the deregulation Powell supported during the previous 4 years. Due to Powell's actions, the U.S. is now more susceptible to future financial crises and taxpayer-funded bailouts, as was the case in 2008. The actions were aimed at the most important reforms after 2008 across 5 key areas: capital requirements, supervision, proprietary trading, living wills to allow stricken banks to be safely unwound, and the amount of assets banks must hold that are liquid and easy to sell. Under Powell, the Fed drastically relaxed each of these financial protection regulations, impairing the regulatory framework's overall structure and significantly lowering banks' capacity for resilience. Deregulation also made it more difficult for regulators and the general public to understand the true state of the banks, which made crisis planning and mitigation more challenging. The capital standards that allow banks to absorb their own losses without failing and requiring government bailouts were decreased by weakening the regulatory stress tests that lenders are required to go through. These include abandoning the presumption that banks would keep lending during difficult times and build up their balance sheets. In such a situation, banks would have been compelled to enhance their capital under the previous criteria. Additionally, the test had previously presupposed that banks would keep paying dividends over the following 2 years, reducing their capital. By removing that presumption, the banks are no longer required to have enough capital to support those payouts. In reaction to particularly subpar supervisory evaluations, the Fed abolished its own ability to limit bank dividends and share buybacks under Powell. When employed, this restriction allowed the Fed to grab investors' attention and give banks encouragement to address their own issues. Additionally, the Fed made it simpler for banks to reduce their capital through dividends and share buybacks, even during times of great crisis. Banks were able to engage in more of these activities both directly and indirectly under Powell. Thanks to investments in venture capital and lending funds, some of which have been demonstrated to be risky and unstable. The financial reform law designed to safeguard Main Street families' jobs, homes, savings, and other assets has been undermined by these deregulations under J. Powell. Please like and subscribe for more videos.